Another major macroeconomic objective of governments is for balanced trade, not to have unbalanced trade, either a massive surplus in trade or a massive deficit in trade. We need to develop that further, and how we can actually measure trade performance. When we consider trade, really, we go to the balance of payments. And within the balance of payments, there are three accounts of international transactions, of money leaving the country, money entering the country. In truth, money can leave and money can enter the country through a whole host of various reasons. There can be massive financial reasons, financial types of transactions, which the capital account and the financial account of the balance of payments measure. We're not going to worry about those. We're going to focus on the current account. So within the balance of payments, there are these three major accounts. And all these accounts measure are the flows, the amount of money entering the country and the amount of money leaving the country. The current account is the one we look at when we are trying to measure trade. And at AS level, that's the one that we focus purely on. We don't worry about these two until later. So, the current account of the balance of payments consists of 4 different sections. You need to know all 4. The top 2 are the most important, because they're the ones that relate to trade. So, the current account measures, number 1, the trade in goods. So, exports and imports of goods. It also measures trade in services. Exports and imports of services. Together, this is known as the trade balance for a country. So when we talk about the balance of trade, when we talk about the trade performance, we're isolating these 2 things. But importantly, all students forget this, it's crazy. There are 2 other parts of the account as well, right? So when we talk about the current account improving, it doesn't just have to be these 2 things, there are 2 other parts of it as well. Albeit these 2 are minor, they're much smaller in comparison to these, but they're still important. Yeah? So, you've also got the income part of the account, and you have transfers. So, whilst these 2 measure the export and imports of goods and services, we have the income part of the account, which measures flows of income, income entering the country or income leaving the country. So remittances are a good example of this. So when, let's say, a UK worker goes abroad and works abroad and earns income, if he then brings that income back to the UK, that's going to be a positive on the current account. Transfers can be government transfers, so the payment of EU fees, so paying fees to the EU. It could be the contribution of aid, so the government paying aid to Sub-Saharan Africa, to India, to developing countries. That's money leaving the country. So that would be a negative on the current account. So, what's measured here is not quantity. It is not quantity, it's not quantity, it's not quantity, it's not quantity. We're not measuring the volume here. We're measuring the value. The value. Alright? We're looking at money flows. It's an account, right? It's an account. So we're measuring financial flows. Money flows. Money is important here. Not volume, alright? Value, not volume with current account. So here, when we talk about trading goods and trading services, we're looking at how much money are we spending on imports and how much money are we generating from export revenue. Alright? And for income, how much money is leaving the country in terms of income, how much money is entering the country in terms of income. So that's the key thing that we're measuring. And when we look at the money flows, the overall money flows, these 4 sections will either be a net positive or a net negative. So, our trading goods. Let's say that in the UK, which is true, we are importing much more than we export. So the money we spend on imports, the money leaving the country, is more than the money entering the country when it comes from trading goods. Well, in that sense, our trading goods balance is going to be negative. For trading services, we export. More money is entering the country from the export of services than money leaving the country through the import of services. So for the UK, that's positive. For income in the UK, more money is entering the country than money leaving the country via income. So that's positive. And for transfers in the UK, more money is leaving the country than is entering the country via transfer, so that's negative. In the UK, that's a huge negative. So overall, you add up all of these numbers, and then you work out whether you have a current account deficit or whether you have a current account surplus. If your overall figure is negative, you have a deficit. So overall, if you have a negative, that means you have a CA current account deficit. If overall your figure is positive, like it is in Germany, Germany and other countries, off the top of my head I can't really remember at the moment, it keeps changing. But yeah, overall if it's positive, you're going to have a current account surplus. Okay? In the UK it's negative, these added together you get a negative number, so you have a deficit. But bear that in mind, okay? It's all about money flows, it's not about volume, it's about value. So the value of all of these things is added up, and then we work out whether we're in deficit or we're in surplus. And remember, it doesn't just have to be because of trade in goods and services. There could be other reasons why there is a current account deficit and a current account surplus. I hope that helps you understand the balance of payments and especially the current account. See you next time. Thank you.